Piece of me, piece of my, take some time. I'm just reading all that so for sure. Let's just find me in my world. Be secure, for the flow. Jesus, be my God.
What's up, everybody? Welcome to the first video of your training. We are going to be starting the boot camp today. Remember, this is going to be a very beginner friendly course. We're going to start from the very beginning. A lot of you guys need your foundation worked on because some of you guys don't even know what you're doing and you've been trading for like 2 years. So it's not to knock on you guys. It's just you guys learn from people that would rather sell you a course, and that's understandable. You know, I don't vilify anybody that sells a course because at the end of the day, you got to make money. You know what I mean? And knowledge is power. Knowledge is monetization, you know? So we're going to be starting from the very beginning. I'm going to help you guys build your building blocks of futures trading. So here we go. We're going to start. What is futures day trading? I made you guys this little slideshow, you know? I hope you guys appreciate the effort that I put into this. It's very simple, you know. I broke out the trading Bible. Honestly, that notebook has so much useless information in it. I wrote down so much shit when I first started that I had to comb through it in order to find the stuff that is relevant to what you guys need. Because I've changed a lot as a day trader, you know what I mean? I used to trade so many different strategies. I used to strategy hop all the time. And then I realized that's dumb. So I stuck to one thing. No, I stick to two things. I have two entry models right now. One that I use for intraday / swing trading when I enter in London session holding. It's not really a swing trade technically. It's more of like a really long intraday trade because I start in London session and then I close out either at the beginning of New York session or towards the end of New York session. And then I also have a breakout strategy that I use daily on basically a scalping, you know. Those are very good entry models as well, but those are a little bit more risky, you know what I mean? Because at the same time, when you take a breakout strategy, you tend to get faked out a lot because of the fact that you have to pay attention to liquidity sweeps, you have to pay attention to different volatility in the market, you got to pay attention to news. But we're gonna get into that later on in the course. You know, at the moment, I just want you guys to brush up on your terminology, what things mean, why to focus on certain things. So we're going to be going through the very basics of basics of basics. We're going to be laying one brick at a time until you guys have a perfect, I wouldn't say perfect, a good foundation, right? This is going to be a beginner to an intermediate level course. I never say expert because I don't believe in expert. You know what I mean? I believe you could be very proficient in something, but I don't believe you can be an expert in something because at the end of the day, you can learn from everybody. You are always learning. If you say you're perfect at something, you're not. That just tells me that you're either very conceited, you know, and that you believe you're the best person alive, when in reality we can learn from everybody. You know what I mean? So I don't believe in expert. I believe in becoming extremely proficient in something. So you could be an intermediate. I don't know. It's hard to explain, but you get the idea. Like, I'm going to make you proficient enough to take trades, make some money, fund your life, and change your life. So here we go. Day one of the boot camp. What is futures day trading? Futures day trading is the buying and selling of contracts within the same day to profit from short-term price movement. Okay? So that means that we're going to buy and sell a stock or an index or whatever. Well, futures trading in general, you're trading contracts. So think of it in terms of like real estate wholesale, right? Where you're buying the rights to the house, buying the rights to sell the house or the contract to sell the house, but you're not actually buying the house. You know what I mean? So in futures, you're buying the rights to, you're obtaining the rights to buy or sell the contract for a certain amount of shares, right? You're betting on the price going up or you're betting on the price going down. It differs from options in a way where futures, you're more dependent on price movement, while options, if you guys know what options trading is, options, you're basically, there's more variables when it comes to options. You know what I mean? You have to worry about price movement as well as what is going on in the market with other companies, what is going on with news, what is going on with basically everything, right? Options trading has more variables. It's a little bit more complex. It requires more of a overhead in order to start. The barrier to entry is very high. I believe with options, you would need a minimum of like $15,000 in order to trade. You cannot trade micro contracts or anything like that. So you can't take a partial contract like you can in futures. Yeah, I mean, you can't take partial contracts in futures anyways because it's one contract, but you get what I'm saying. So we're going to move on. What is a contract and what does it tell you? So the contract is the rights to buy or sell a certain instrument. I'm going to go through all the terminology of what you guys need first, like later on in the video. But an instrument is basically the commodity or the stock that you're trading. So whether it's an index, commodities in terms of like silver, gold. No, those are metals. Commodities would be like crude oil and stuff like that. So it tells you what market you're trading, how much one price movement is worth, the smallest price movement, and how much that small price movement is worth, and then how long you are allowed the rights to sell or buy it. An example of a contract, we're using S&P 500 right here. One tick would be the smallest allowed movement on that contract, and it would be equal to 0.025 points, right? So that would be like think about it in terms of like decimal points, right? So one tick would be like 0.025. So like, let's say it's $1,000.25. One tick would be $1,000.50, right? So one tick, the value of the contract will tell you the value of one tick equals $12.50 for S&P 500. So one point would be $1,001 instead of $1,050. You get what I'm saying? So it would be 1 point, the value of 1 point would be $50. So for S&P 500, 4 ticks equal 1 point. And then it would tell you the expiration date. So for example, it would expire on 1/1/26, so January 1st, 2026. But when it comes to futures trading, most of the time we're going to be day trading futures, so you don't really have to worry about the expiration date, but you have to pay attention to it in terms of like, it's hard to explain. So it's not really hard to explain actually. So you have to pay attention to it, but it doesn't factor in as much. Excuse me, I burped. So for example, with an options contract, you have the rights to buy or sell one contract. One contract in options is 100 units of the stock, right? So you have 100 shares, and you have that 100 shares for, let's say you bought it in October. You have until January 1st, 2026 in order to sell that stock to basically profit from it, right? But with futures trading, you have your short-term holding. So you can hold it for like 1 second, 1 minute, 10 minutes, a couple of days. But you have to pay attention to when these contracts roll over, right? So once these contracts expire, it's going to renew the contract, let's say on 1/1/26, for example, right here, right? When you're futures day trading, you need to pay attention to these expiration dates because it will cause volatility. I'll explain what volatility is later, but it will affect the price in a way where it's not, I wouldn't say predictable, but it's not stable anymore. You know what I mean? So once, let's say you take a trade and then you have like 10 minutes before the contract expires. And then once the contract expires and then renews, but you're still in the trade, it could randomly just drop and then go back to where it was before. You know what I mean? And that would end up hitting your stop loss and causing you to lose money and stuff like that. So we have to pay attention to these expiration dates. Not as much, but if you're using a platform, most of the time it will tell you on the bottom, it will have like a little symbol that tells you that either news or a contract is going to be rolled over or expiring. So an important note, these ticks that on the contract vary. They're not the same for every instrument. So the instrument, let me just tell you what an instrument means first, so that way you guys can understand the vocab. Instrument is basically what you're trading. So an instrument, another way to say it would be a ticker symbol in stocks or options. So ticker symbol. So the instrument would vary based on the ticks would vary based on the instrument. So for example, crude oil, CL, 100 ticks equal 1 point. So 100 small movements equal a $1 movement, if that makes sense. NQ, 4 ticks equal 1 point. ES, 4 ticks equal 1 point. So it would be NASDAQ and then S&P 500. And then gold, GC, 10 ticks equal 1 point. YM, Dow Jones, 1 tick equal 1 point. Okay, so why is it important to know the value of each price movement? So when you're getting into an instrument, and you need to know the value of the tick because of the fact that it will help you calculate your risk per trade. Sorry, that water made a lot of air. It will allow you to calculate your risk better, right? If you're going into, let's say, NASDAQ, right? NASDAQ, no. Let's say you're going into, NASDAQ versus YM, right? Dow Jones. The value per tick costs more on NASDAQ versus the value per tick on YM. So if you're assuming that it's all the same, it's going to really hurt you, or it might cause you to go in with less risk than you were originally planning for. You know what I mean? Because normally, conservative day traders, they usually risk around like 1%. But the super safe people usually really risk around like 0.5%. But that 0.5% on YM could be like $10. I mean, that's really undervaluing it, but like, you get what I'm trying to say. Like, that value of that tick could be like $50 versus NQ, that value of that tick could be like $300. You know what I mean? So it's very important to pay attention to these tick values. If you click on, I'm going to show you guys later on in the course, but you're going to be able to click on the contract, and it will tell you before you buy or sell what the value of each contract is, and it will describe everything to you before you can place it. You can read it within like 10 seconds. But technology nowadays, you don't really need to look at the values of this stuff. All you need to do is go into a profit and loss calculator and then click on the instrument that you're using, and then basically type in where you're entering, where you're going to take your profit, and then where you want your losses to stop. And it will tell you exactly how much you're going to make and how much you're risking. But that's varied on like the strategy that you're using. So for example, on a breakout strategy like I do during the day, it's hard to pre-plan. So when it's hard to pre-plan, you need to be able to know how much these ticks cost in order for you to go into the correct amount of contracts, so that you don't over expose yourself when you're taking the trade, right? But when you're taking like my intraday / swing trading strategy, you have the ability to use these calculators that will allow you to pre-plan your risk and pre-plan your trade beforehand. So yeah, that's important to know. This will help you with your risk per trade, your stop loss size, so the amount of money you're willing to lose if you're wrong on the trade. Your position sizing. Position sizing would be how many contracts you're going in with, and then your daily loss limits. So let's say you want like 10 contracts, right? Of like, let's say X instrument. Your daily loss limits would be like, oh, I'm willing to lose like $700 today, right? Every day I'm willing to lose $700 in order to make X. Blank, blank, and blank, right? So you can take 6 or 7 trades and you not hit your daily loss limit yet if you know the ticker symbol. I mean, if you know the ticker value, right? The tick value. So I see a lot of people on TikTok saying like, oh, I went in with like 1 lot. I went in with like 2 lots. So the important thing to know the difference between a lot and a contract. So lots vary in amount. Contracts are fixed amounts, okay? So let's say lots are normally used for Forex. So when you guys are saying lots, it is completely wrong. So you need to stop saying lots and you have to say contract. And you have to say stop saying unit and you need to say contract, because one unit could mean many different things and one lot is very different. So one lot in Forex, if you guys don't know what Forex is foreign exchange market. And it's the same thing as trading, except you're trading money. So let's say, for example, you're betting on if the US dollar is going to be stronger than the pound, right? Or the pound is going to be stronger than the US dollar, stuff like that. But one lot is very different, right? A contract is very different. A lot is varied. So it's a varied amount. Contract is a fixed amount. You have to think about it in terms of like fast food. A lot, you're ordering a la carte. So like, I want three medium fries, right? You're going into the trade with 3, let's say you're trading 3 medium fries. A contract is like ordering a combo. You have a set amount of stuff at a fixed value. So why is this important? When it comes to Forex, one lot can mean very different things than one contract. One lot refers to how many units. Like I said before, it's ordering a la carte. So one standard lot is 100,000 units. One mini lot is 10,000 units. One micro lot is 1,000 units. So when you're doing this and you're saying these things, right, and you're calculating your risk based on the word lot, it can mean very different things. So one lot, for example, could mean 25 cents, because Forex is very different when it comes to lots, while one contract could carry a risk of like $500. You know what I mean? You have to be extremely aware of the type of language and the type of vocab that you're using when you're trading. How you do one thing is how you do everything. Okay, you just got to remember that. So let's learn about the differences between a mini contract versus a micro contract. So a mini contract is a standard agreement that is one full contract. A micro contract represents only a tenth of a mini contract. So let's say if you're trading mini Dow Jones versus micro Dow Jones, one mini Dow Jones is 100 shares. One micro Dow Jones is still 100 shares, but the value of the tick is very different. So for example, ES, the S&P 500, one mini contract, one tick is valued at $12.50. And 4 ticks, like we showed earlier, 4 ticks is 1 point. So 1 point would be $50, right? And then when you're going with a micro contract, 1 tick equals $1.25 versus 4 ticks, 1 point would equal $5, right? So when do we use mini contracts versus micro contracts? When you're using a mini contract, most of the time when you're using mini contracts, you already have the capital behind you in order to take a mini contract. Or you believe in your trade and you have a confidence that that trade will go up or go down. So I use, for example, if I have everything that I need and all the reasons that I need for the market to go up versus go down, right? I would end up going in with like one mini. So like let's say, for example, let's use S&P 500 again, right? So one mini contract on S&P 500, I'm willing to risk $12.50 per tick because I have a confidence that this is going to go up, right? It's going to move very fast. The money is going to be changing extremely fast when you use a mini contract because mini contracts is based on speed and pressure, right? The more speed, the more speed the candle is moving, the more pressure it's moving, the more money you're making and the more money you can lose, right? So a lot of beginners should go through micro contracts. Micro contracts allow you to control the amount of risk that you're using because one tick only equals, on S&P 500, one tick only equals $1.25, right? So every point that you're moving is $5 versus every point you're moving on a mini contract would be $50, right? So it varies based on trading strategy as well as trading confidence as well as like your what's the word? What's the word? Your understanding of how to trade, right? Like your confidence in the trade, or a lot of people use micro contracts to like scale in and scale out of trades. So like let's say I went in with 10 micro contracts, right? 10 micro contracts would equal one mini contract. But when you're going on in with one mini contract, you can't split a contract in half, right? So with micro contracts, that gives you the ability to split profits, right? Or take some profits and leave some of the contracts running. So let's say I'm betting on S&P 500 to reach $2,000. It's currently at 1,000. I enter a buy trade. I enter with 10 mini micro contracts, and then it hits $1,500. I'm gonna sell 5 contracts and allow the rest of the contracts to continue going, right? So that's the way you can utilize the different ways to basically protect yourself in a way. Micro contracts also allow you to scale up. So like let's say it hits the $2,000, but I see that there's a lot of buyers entering the market. I can add more contracts, but I don't want to add one full mini contract because I don't want to risk $12.50 per tick. So I can go in with 5 micros and I would be at a total of like 15 contracts, right? Instead of 20 contracts or 2 mini contracts. That's a little confusing, what I just explained right there. But the more you trade, the more you're going to understand it a little bit more. So this just comes with more experience, more time in the market. But that just gave you a little bit of what you're supposed to do, right? Not what you're supposed to do, but like a little bit more understanding of what a mini versus a micro is, right? A micro, just remember that it's 1/10 or 10 times less value than a mini contract. So here's some of the basic terminology that you're going to need to know in order to continue on with this this course, because I'm going to be saying a bunch of these things, so I want you guys to know exactly what I'm saying so that way you're not lost. So what is a market order? A market order is I want to buy or sell right now. Okay, let's say a price gets to a certain point, you're like, oh, I want to get in. Market order, that's when you want to buy or sell right now. A limit order is I want to buy or sell when the price gets back to a certain price point. So let's say it went to $1,000, right? And now we weren't paying attention, or we're pre-planning our trade, and we want to have price go back because we believe that $1,000 is a fair value for buyers to come back in and push price back up, right? So we would place a limit order telling the platform, I want to execute a buy when price goes back to 1,000 and then shoots back up, right? Or you want price to come back up to a certain number and then shoot back down. So that's what a limited order is for. A stop order / stop loss is an oh crap button, right? It's I'm losing money. Get me out of this trade right now. Don't leave me in this trade. Stop my losses. Okay? The stop loss / stop order is the most important order you can have. Okay? You want to use this every single time you're trading. Because of the fact that if you don't, you can lose extremely fast. Like, let's say you are not trading prop firms. A prop firm is a company where you can pay a certain amount of money to take a test and prove that you're a good trader. If you can prove that you're a good trader, they will allow you a certain amount of funds that you could trade with, right? But if you hit a certain loss limit, they will take that account away, right? So with that, a stop loss will allow you to limit the losses that you have so that you don't lose the account. On the flip side, if you have your own account where you're not using somebody else's money and you're using your own money, a stop loss will allow you to not lose all of your money. It's basically self-explanatory. So an instrument, the instrument, as I said earlier, it is what are you buying or selling, aka the ticker symbol. The ticker symbol would be YM for Dow Jones, NQ for, it's basically an abbreviation of the actual market that you're trading in. Margin would be the money required to open a trade. Day trading margin is the minimum amount of money required to take a short-term position. So when in terms of like day trading, so like how much money do you need in order to trade for this session in an 8-hour trading day? Is it 8 hours? 9, 10, 11, 12. 10, 11, 12, 1, 2, 3, 4. Yeah, 8 hours. Right? 7 hours. No, it's 7 hours. 7.5 hours, something like that. Whatever. I'm not good at math. Sorry. Okay, so maintenance margin, the minimum amount required to hold a position. So let's say you are swing trading. You're going to need a certain amount of money in order to hold that position for a certain amount of days, because price is going to fluctuate so much in those amounts of days that sometimes it could hit the minimum required amount for you to keep that account open. You know what I mean? So maintenance margin would be the amount of money to hold a certain position. Leverage, if you gamble or you're anything, you kind of know what leverage is. It's using margin. So margin, the money required to open a position, you're using margin to control larger positions with less capital, right? I'm pretty sure everybody knows what leverage is. And then risk per trade, the amount is the amount that you're willing to lose on one trade. Remember, if you guys are getting bored, I apologize. Actually, no, I don't apologize, because some of you guys need this, right? You guys have been trading a long time. Some of you guys don't even know any of this. So yeah, I'm not sorry. So forget you guys. Yeah. We're going from basic, baby. We're starting from brick by brick. All right. Risk per trade is the amount you're willing to lose on one trade. Max daily loss is the maximum loss allowed in one trading day. This can vary from brokerage to brokerage, depending. No, not brokerage to brokerage. This depends on you in general, right? Like, what are you willing to lose on any given day? Like, what is your loss tolerance, right? Risk to reward, RR, would be risk to reward. How much you're willing to lose, or how much you're willing to lose in order to make blank amount. Okay. Unrealized P&L equals the money you would have or lose if you closed the trade that you are in at that moment. A realized P&L is the money you gained or lost after closing an order or a position. Entry is the price where you entered at, or you opened a position or opened a order. Stop loss, Price where you exit to limit loss of money. Target/take profit is price where you exit for a profit. Partial, closing part of a position. So for example, I have 10 contracts at $1,000 I entered, $1,500 is where it's at. I sell 5 contracts and then I leave the rest to keep going. I would take partial profit in order to capture the bigger move. A runner, the remaining contracts left after you take a partial. So the 5 contracts that I left over would be considered, would be called runners. And then these are the most common instruments. So we have ES. Everything's going to start with most. If it doesn't have an M in front of it, it is the mini version or the standard contract for that instrument. So ES is the standard contract. So E mini S&P 500. That would be the standard contract for S&P 500. If it has an M in front of it, so MES, it would be micro S&P 500. So you would be trading the 1/10th contract. Okay. So we have ES would be S&P 500. NQ would be NASDAQ. YM would be Dow Jones. CL would be crude oil. GC would be gold. And then we have, I believe, PL would be platinum. All right. Those, well, 1, 2, 3, 4, 5, 6. Yes, those 6. I forgot to put platinum on here. But those 6 are the majority that you are going to be trading for futures. We do not trade individual stocks when it comes to futures. We are trading indexes or indices, for example. So yeah, that is day 1 of the learning how to day trade futures video. We are in boot camp. Remember guys, I don't know if you guys know this or don't know this, but it is good to start with a good foundation. So if you believe that you know everything, I promise you, you don't. I promise you, I don't. Like, I want you guys to start off with a good foundation in order for you to guys to, let's say, we're putting in the rebar right now, okay? We're putting in the rebar. If you guys don't know construction, it's the metal bars that go inside concrete to brace the concrete so that way it's stronger, so that it will last for years to come. I said this in one of my videos before. If you're building your foundation on mud, it does not matter because you're just going to slip. Your foundation is not going to be strong enough. Your house is just going to slide away and it's going to break away and it's going to erode away. Okay, so we're going to keep building on these foundations, building on these building blocks. And yeah, I'm going to turn you guys into the most proficient traders. At the end of the day, remember, this is about getting proficient at trading. And you also have to remember, don't hold me to an extremely high pedestal. I am still learning as well as you guys are. You know, I have more experience than you guys, but at the end of the day, I am also still learning. So I am not perfect at this trading stuff. I do make good trades. Sometimes I make bad trades. Sometimes I am perfect for X amount of days, and sometimes I mess up for X amount of days. You know what I mean? Nobody in this world has a 100% win rate. It is impossible to have a 100% win rate. If you have a 100% win rate, you're basically the company. And I don't even know how to explain it. Like, if you have a 100% win rate, you can see into the future. Might as well be Marty McFly. All right. So thank you guys. I hope this video helped you. I hope the people that already knew how to trade kind of learned something new that they didn't before. If you guys already knew this, I apologize. No, actually, remember I said, no, I don't apologize. If you guys knew this before, so hopefully this helped you brush up on some of the stuff that you knew already, that you forgot about. And yeah, let's keep it going, guys. Thank you guys for watching. Remember to hit the like button, comment, subscribe, share this with somebody that might need it. Let's build this community, guys. Let's build this community. Let's help other people. This is always going to be free, okay? I'm going to help you guys. I'm going to keep posting my trades daily, by the way, too. So if you guys are going to keep up with this, hit the subscribe button. Turn on notifications, by the way, too. So that way you guys can see my daily trades. I'm going to be trying to live stream as well, too. So hopefully that will help you refine your trading as well by watching somebody who trades, trade in front of you. So yeah, thank you guys. Remember, like, comment, subscribe, share the video, and see you guys in the next video.